Hello and welcome to the Tax Roundup for December 2014. And just to prove there's never a dull moment in tax, Treasury has released the exposure draft on the 10% withholding tax that will apply to sales of property by non-residents. We also look at two important decision impact statements that may change some of the deductions available to your clients. And first, just because it's Christmas, a very quick Christmas cracker joke. Why are horse-drawn carriages so unpopular? Because horses are rubbish at drawing. Anyway, now on to the more important business. Ray will take you through that exposure draft on the withholding tax that will apply to non-resident property sales.
We finally have some more information following on the 2014 budget announcements in relation to the 10% withholding tax that would apply to non-residents selling property in Australia. Now, this is due to take effect from the 1st of July 2016. And basically what's supposed to happen is that the purchaser will be required to withhold 10% of the gross proceeds and remit it to the ATO. The vendor, we assume, would then have to file a tax return in order to claim any excess tax credits back. The Treasury did release an exposure draft and went through quite a lot of the detail of how they think it would work and some of the practicalities. However, they haven't yet announced when the draft legislation will be issued, so we're still waiting for that. At least we know that one thing that's been consistent is they have confirmed that there will be a carve-out where the property is worth less than 2.5 million. So that would mean that an awful lot of taxpayers that might otherwise be caught by this measure will be able to be exempt.
Next year, economists are telling us that we could be in for a very rocky ride economically. Now, for those of us that have been around the tax space long enough, you know that that will mean extra attention by the regulators on every dollar of tax revenue available. If you have not already called Accountancy Insurance and spoken to them about Audit Shield to protect your client against the cost of audit by the regulators, then give them a call on 1300 650 758. But now Michael's going to take you through those two decision impact statements, the first looking at travel allowances and the second on retirement villages.
Now, this month the ATO has released a decision impact statement on the Gleeson case. This was an AAT case that you might remember from the last 12 months or so. This case dealt with a taxpayer who was a truck driver and was trying to claim deductions against a travel allowance that they received while they were travelling overnight in the course of their work. And there were two big issues here. Was firstly, whether the allowance that the taxpayer was receiving was a bona fide travel allowance, which would enable them to access the Commissioner's reasonable rates. And the second issue was around the deductions themselves. So could the taxpayer claim deductions, and did they qualify to actually use the ATO's reasonable rates? Now, the AAT confirmed that the allowance that the taxpayer received was a bona fide travel allowance. It was paid in respect of overnight travel. And the key issue was that the ATO didn't like the fact that the allowance was based on a cents per kilometre rate. The AAT said, look, that doesn't matter. We look at, is this an allowance that is paid to cover meal expenses while someone is travelling overnight? Now, because the answer to that was yes, then the taxpayer was able to rely on the Commissioner's reasonable rates. So they didn't have to keep receipts and invoices for their meal and drink expenses. The AAT also looked at whether this taxpayer had actually incurred those expenses. So just because you qualify for the ATO's reasonable rates, all it means is you don't need receipts and invoices, but you still might need to justify to the ATO that you've actually incurred the expenses that you're claiming. In this case, the AAT was satisfied that the taxpayer did actually incur those costs. The taxpayer was able to point out that typical expenses, so the cost of a sandwich or the cost of a coffee at a truck stop on the highway, the fact that if they're paying these amounts on a regular basis for the number of days they were away, they would have incurred the expenses that they had claimed. So just the important warning for clients is that even though they might be receiving a bona fide travel allowance, which enables them to access the Commissioner's reasonable rates, there's that extra step required, that they may get asked to still justify the fact that they've incurred those expenses. So we've got that two-step process, receiving the allowance, but also possibly having to justify to the ATO what expenses have been incurred. A potentially simple way of dealing with that in practice might be a really basic diary. So where the client just keeps a quick logbook of what they bought, roughly how much it cost, and that would just build a bit of evidence for them in case they are asked about it in future by the ATO. Now, my Christmas cracker joke is, how does Santa's accountant value his sleigh? Well, at its net present value, of course. The other decision impact statement that's been released by the ATO this month relates to the retirement village case that went through the AAT recently. Now, briefly, what happened in this case was that a retirement village operator was required to make certain payments to a resident when they left the retirement village. And there was a formula for working out how much that payment was. The retirement village operator had been claiming deductions for those payments. The ATO disagreed with that and had disallowed the deductions. Firstly, on the basis that there wasn't a sufficient connection between the payment and earning assessable income from the business. The ATO also claimed that those payments were capital in nature. They were payments made when someone left the village, and so they're actually a capital in nature expense, so not deductible. The AAT actually found for the taxpayer in this case. The AAT found that those expenses, or those payments that were being made, were part and parcel with the ordinary business activities of the retirement village operator. We had residents coming in and leaving on a fairly regular basis. The payments that were made were an ordinary part of that business activity. So there was a sufficient connection between the payment and earning assessable income. These were necessarily incurred expenses as part of that business. When it came to the capital revenue distinction, the AAT also found for the taxpayer and said, again, this is a recurring expense. It's an expense that is an ordinary part of the business activities. It's not a capital expense. So good news for the taxpayer, they're able to claim an immediate deduction for these payments. Now, the reason the ATO has issued this decision impact statement is because it does impact on previous statements made by the ATO. So the ATO has also made some amendments to form a tax ruling that deals with this issue. From a practical point of view, really important for practitioners to be discussing this outcome with their clients who do operate retirement villages, just to check whether there's any potential deductions that can be claimed in prior years. If so, we need to keep an eye on amendment periods, because going back 2 or 4 years, whatever the case may be, just need to have a look at when would those amendment periods end for the purpose of going back and claiming deductions. If it looks like an amendment period may either have ended or be close to coming to an end, then the other option is looking at lodging an out-of-time objection against the previous assessment in order to try and claw back some of those deductions and hopefully get a nice refund for some of your clients. But now's the time to have those discussions, identify clients who might be affected by this decision, and also those clients who might be able to go back and amend tax returns. My other Christmas cracker joke, because I bet you can't wait for another one. How do Santa's employees lodge their personal tax returns? Under the ELF assessment system.
Finally, Ray looks at a case that outlines the factors that come into play when you're asking the tax office to waive a tax debt on hardship grounds.
The Watson case was quite interesting as it went through some of the factors that are considered when trying to argue serious financial hardship in relation to potentially getting a tax debt waived. Now, Mr. Watson had tax debts relating to 4 different years and obviously GIC and penalties as well. And interestingly enough, one of the arguments he put forward was that the Commissioner had a not moral obligation to ensure that he could maintain his life with dignity, and therefore, please don't pursue me for the tax debt. Unfortunately for him, the Commissioner didn't agree, and neither did the Small Tax Claims Tribunal. Some of the factors they went through were in relation to Mr. Watson's case, that he put other creditors ahead of the tax office when paying his obligations. There was no serious misfortune or something outside his control which enabled him to not pay his debts. He just made some poor choices. He had entered into payment arrangements with the tax office and unfortunately defaulted on those arrangements. So there was quite a few factors to be considered. And his argument that if he had tried to pay all the tax debt, he could end up bankrupt, didn't really hold much sway. The Commissioner was not moved, and unfortunately it was the court. What they did also held is that in addition to these factors, the taxpayer's argument that the Commissioner had a moral obligation to let him live in dignity was actually swayed and countered by the fact that the taxpayer had a moral obligation to pay his taxes, as we all do. Now, the Commissioner did recognise that Mr. Watson was going through a difficult time. He was on a disability support pension and unemployed and no expectation of future income. So they agreed to take a hold action on the debt and not actively pursue it at this time. However, they did not cancel the debt. The tax debt is a tax debt and will remain. So even though in this particular case, the tax office agreed not to take any further action, they did not agree to waive the debt, and should circumstances change in the future, Mr. Watson will still be required to pay it. What do you call someone who's afraid of Santa? Claustrophobic. Happy holidays, everyone.
And my final Christmas cracker joke. What did the snowflake say to the fallen leaf? You are so last season. Sorry, that was actually quite terrible. If your firm is not a member of Knowledge Shoppers yet, then give Julie a call on 1800 800 232 and she'll make sure that you have a very happy new year. On behalf of Knowledge Shop and all of the team, I'd like to wish you a very Merry Christmas and a safe and happy new year. See you then.